What's happening, everybody? It's your boy Creative. Go ahead, say it with me. We are back at it again to do what? To create something great. Now, today we're going to be dropping another episode in our Creative View series. I'm super excited for this. We're going to be talking about one of the big boys in the town. We're going to be talking about SPY, and SPY is the S&P 500, the top 500 companies within the New York Stock Exchange. And we're going to be breaking this down so we can understand the history of it, what makes it an ETF, the top, what are some of the companies within the holdings, right? And we're also going to be bouncing back and forth between actually looking at SPY, the data of SPY, being able to go through some of the holdings of SPY. So don't worry, this is going to be quite comprehensive. If you haven't already, I need you to make sure that you like and subscribe. So without any further ado, let's go ahead and jump into this. So what is SPY? The S&P 500, the top 500 companies within the New York Stock Exchange, right? So SPY is an index of the 500 biggest US companies, right? So think of it like the report card of the market. So individual traders, or for myself at least, right, I like to use SPY to be able to gauge what's going on in the market real time, right? So that's how we can be able to use SPY. We're also, I'll say that for later. So it's an index. What is an index? A number tracking a group. We can't buy it directly. Excuse me, I didn't want to burp in your ear. So market cap equals the company's total value. This is the price times the shares that are outstanding. Weighing is the bigger companies equal a bigger impact on the index. What is the index? Index is a number tracking a group, right? Blue chip is going to be a big, stable, famous company like Apple or Microsoft. A committee is a group of people who decides things, not a robot or AI, right? Now, maybe that'll change soon, but I don't think in the near future. Criteria is going to be the rules you must meet, like requirements for a club, right? 21 and older type shit. All right, let's keep going. So imagine the 500 biggest companies in America had a report card showing their average performance. That's the S&P 500. It tracks Apple, Microsoft, Nvidia, tech giants, Amazon, Walmart, retail, JP Morgan, Bank of America, banks, and 494 other major companies, right? So that's why I like to use SPY as the gauge of like, all right, what's going on, or excuse me, the S&P 500 as a gauge of what's going on, right? When the S&P 500 goes up, these companies are doing well and the economy is healthy. So technical definitions is the S&P 500 is a market cap weighted index of the 500 largest US companies. So I'll say that again, the S&P 500, because you may see that again. So we're going to be breaking this down into lessons, and each lesson is going to have a check for understanding. So I need to make sure that you're following, right? So there may be a couple of things I want to repeat for emphasis because you may see it again. So the technical definition is going to be the S&P 500 is a market cap weighted index of the 500 largest US companies. It represents 80% of the total US stock market value. Memory trick, the S&P 500 equals America's economic health report card. So key facts about the S&P 500, it is market cap weighted. Bigger companies have a bigger impact. Actually, there are 503 stocks, and you may see that again, right? So there are 503 stocks. Some companies have multiple shares. 11 sectors within the S&P 500. You got to have a way to be able to categorize it, right? So these 11 sectors are tech, finance, healthcare, energy, and some of the same banking, as you saw, right? Retail, as you saw, right? And many other sectors. So you can't buy it directly. It's an index. It's not a stock. So a live look at the S&P 500 currently, right? It's at the 6,963. It's up 30% or 4.5% of the year. Excuse me, for the day. Currently, the 52-week high is 7,002. 52-week low is 4,835. So here's a visual of it. So technology makes up 34% of the S&P 500. Finance makes up 12%. Communication services makes up 11%. Consumer cyclicals makes up 10%, healthcare 9%, industrials 8%, consumer defense 5%, and then energy 3%. And then technology, as you see, dominates at 34%. So an example would be Nvidia's 4.5 trillion in market cap, right, versus the smallest company's 1 billion. If Nvidia goes up 10%, huge impact on the S&P 500. It's in 7% of the index. So if a small company goes up 10%, barely moves the S&P 500 because it is a tiny fraction of the index. So the top 10 companies equals 38% of the entire S&P 500 index. Right? So how do companies get into the S&P 500? It is not automatic. It is a committee decision. So the S&P 500 Index Committee, real humans, right, pick members, right? Think of it like a VIP club with strict entry rules. So requirements to join is it has to be a U.S. company. The market cap must be greater than approximately 18 billion. But there's going to be some cases where we're going to have companies that are going to have less than that 18 billion, right? It must be profitable. Earnings for the last 4 quarters. High trading volume. High trading volume means that it's super liquid because S&P 500 prides itself on being liquid. What is liquid means? You can easily get in and get out of trades without worrying about being stuck in that trade. And at least 50% of the shares must be publicly traded. So famous example, Tesla was big enough for years, but the committee waited until December 2020 to add it. They wanted to see if the sustained profitability first. The size alone isn't enough. Companies also gets removed too, right? If a company shrinks, it gets acquired or goes bankrupt, the committee swaps it out. So 20 or 30% changes happen every year. So let's go ahead and jump into where we can actually look at some of the holdings, right? So currently under management has over $700 trillion, right? Currently under management. And here's the top 10 companies within the S&P 500. And again, these top 10 companies, let me just make this bigger so you can see that these top 10 companies represent 38, let's get that right, yeah, 38% of the entire S&P 500. We have Nvidia, that makes sense. We have Apple, we have Microsoft, we have Amazon. This is Google, right? Don't ask me why they decided to call themselves Alphabet Class A, but this is Google. We have Broadcom, we have YouTube. How ironic. This is Facebook. I would never call you Meta. Then we have Tesla, and then we have Berkshire Hathaway Class B, right? So these are the top 10 companies that make up, these are the top 10 companies, right, of the S&P 500, but there are 490 others within them. So let's go ahead and go back to our code, and then now we have a couple of checks for understanding. All right, how many companies are in the S&P 500 index? Remember, we may see that again, right? Exactly 500. Maybe. Actually 503 stocks. Some companies have multiple shares. I think I heard that before. It varies between 490 and 510. If you say that, you haven't been listening at all. All right, beautiful. We got it right. Companies like Alphabet, Class ABC, Google, and Class C, Google, both shares are included. And then we have Google, and that's YouTube, right? What does market cap weighted mean? All companies have the equal impact? Probably not. Bigger companies have more impact on the index. I think I heard that before. And then only the top 100 companies matter. Probably not. So just by process of elimination, we're able to deduce that it was B. Why bigger companies have big companies by market cap have more weight. Nvidia at 4.5 trillion has way more weight than a $1 billion company. That's kind of crazy to think about it, but hey, a trillion is bigger than a billion. It's crazy. Top 10 equals 38% of the S&P 500. Can you buy the S&P 500 index directly? Yes, just type CSPC in your brokerage. You're probably going to crash it. So that's probably not right. No, it's just a number. You need an ETF like SPY, right? We're going to more on SPY later. Only institutional investors can buy it. So probably not. All right, so let's go ahead and go to lesson 2. Lesson 2 is SPY, the ETF that tracks it. So ETF is an exchange traded fund, a basket that you can buy like a stocks. Basket you can buy like stocks, right? Tracking error, how closely ETFs follow an index. Excuse me, tracking error. How closely an ETF follows its index. SPY tracks it tight. Expense ratio is going to be the annual fee. SPY charges 0.09% per year in order to manage SPY, right? So that comes in many different ways. Probably some of that is going to be your management fee, right? Some of that is going to be your admin costs. Some of that is going to be the cost of being able to meet. So there's going to be many different costs that's baked in to that 0.09% per year. Liquidity is how easy it is for you to be able to buy and sell. SPY is one of the most liquid ETFs ever, right? That's one of the things that they pride themselves on. The S&P 500 is being super, super liquid, right? NAV or NAV is the net asset value, true value per share of the ETF. And a dividend is a cash payment from companies' profits. SPY pays quarterly dividends. A yield is the dividend as the percentage of the price. So SPY dividend is approximately 1.2% per year. And then DRIP or DRIP is the dividend reinvestment plan, automatically buy shares, right? And that's what you should do. What's the point of like cashing out $2? Just reinvest it, go buy more shares, right? All right. So you can't buy SPY directly itself. It's just a number. It's a scoreboard, right? But you can buy, you can't buy the S&P 500, right? The S&P 500 is the scoreboard, but you can buy SPY. It is a copy that you can buy. So think of it like this. The S&P 500 is the recipe for the cake, and SPY is the actual cake that you can eat, right? So SPY owns a tiny piece of all the S&P 500 companies. It is the exact same proportions for the S&P 500. The S&P 500 or SPDR, S&P 500 ETF Trust, is the oldest, most liquid ETF. Launched in 1993, it tracks the S&P 500 with an expense ratio of 0.09. Memory Trick SPY is a copy of the S&P 500 that you can actually buy. So let's take a live look at the SPY, or at SPY, not the SPY, at SPY, right? And SPY right now is at 693.95. The volume for today is just under 72 million, right? Just above 72 million, excuse me. And the average for the day is 82 million, right? So high, super, super high liquidity. So SPY ETF details is asset managed. So assets under management is 694 billion. The expense ratio is 0.0945 per year, and it's holding 502 stocks. So you may see this information again. And its inception date was January 22nd of 1993. So visual. So the tracking error is 0.01, nearly identical. Why the tiny difference? The expense ratio. This is the SPY annual fee. A small cash drag from the dividends, rebalancing cost, right? So bottom line, SPY tracks the S&P 500 almost perfectly. Why is SPY so special? The first ever ETF ever launched it. Oh, look at that little Jeopardy question. It was the first ETF ever. SPY, the S&P 500, which tracks the S&P 500 perfectly, almost perfectly, within 0.09% of it due to the expense ratio. Launched January of 93. A revolutionary product that created the ETF industry. The most liquid, there's 50 billion plus that are traded daily. You can buy and sell millions of SPY instantly. Cheapest, only 0.09 expense ratio. $100,000 invested, you're only paying $90 a year in fees, right? So that's not that bad. Tax efficient. The ETF structure minimizes taxes, so better than a mutual fund for taxable accounts. One thing I want to say is that this is not financial advice. If you do seek financial advice, please make sure you talk to a certified financial planner, those that are licensed in order to assist you. This is merely educational. All right, let's keep going. So SPY versus VOO, Vanguard, and then IVV, which is BlackRock, right? So look at the expense ratio. So you can see that Vanguard and IVV, but BlackRock is a little bit less. The assets under management looks like SPY is clearing lead, almost by 200, if not 300 billion, and that's kind of very, very telling, right? Lower fees, but the assets under management is not the same. So all track the S&P 500. You pick SPY for trading, and then VOO for long term, right? If you want to be able to hold it, but again, you just have to be able to keep in mind the assets under management. So SPY pays you a dividend, right? When you own SPY, the 500 companies inside it shares profits with you. That's called a dividend. SPY pays 4 times a year. It is March, June, September, and December. SPY price chart shows a 10% annual return. So with the dividend reinvested, that's 11.5%. That's the DRIP, dividend reinvestment plan, right? We already talked about that. Dividend reinvestment plan, when you automatically buy shares. So why that matters, SPY price chart. Okay, excuse me. So here's a live look at the amount of dividend that you would get just on the amount per share, right? So as you can see, it is increasing. We did touch 1.9. It did dip a bit, but it is reaching back to its high at 1.9. So that's what's up. So an example, if you own $10,000 in SPY over 30 years with no dividend reinvestment plan, you're at $130,000. But with a dividend reinvestment plan, DRIP, right, you are at $180,000, $50K extra just with being able to reinvest dividends, right? So turn on dividend reinvestment plan in your brokerage to automatically buy dividends, right? Because what's the point in being able to get those couple dollars, if not a couple $100, just buy more SPY. If you're not going to use it anyway, right? So what is SPY's expense ratio? You have been listening. It is not 1%. That'll be crazy. Free. Yeah, all right. Beautiful. Why is SPY more expensive than Vanguard? SPY is a scam with hidden fees. No. SPY is older, more liquid, premium for trading. Vanguard is subsidized. The VOO is subsidized by Vanguard. So just by process of elimination, we can go ahead and deduce this B. Why SPY was the first. When you're the first, you can always charge what you want, right? And it's one of the most liquid, almost 50 billion in trading volume a day, right? You pay a tiny premium for the instant liquidity, being able to get in and out of the position real quickly. VOO or Vanguard is better for buy and hold positions. So if the S&P 500 index goes up 10%, SPY will go up exactly 10%. Perfect tracking. Not really, because again, you have to pay that expense ratio. So 9.91% after the expense ratio. So that sounds a little bit better. 12% SPY outperforms with active management. Okay. Don't let them sell you that dream. So just by process of elimination, we can be able to see that it is that 9.91%. All right, so let's go to DCA. I think, yep. Historical returns and bull and bear cycles. So we're on lesson 3 already. We're making great time, fam. So a bull market is when a stock is going up over time, is the climbing the stairs slowly. A bear market is down 20% from the peak, is the elevator drop, fast drops, slow climbs, right? So remember that. Fast drop and a slow climb. So bear market could be a fast drop, bull market could be a slow climb, but you're still climbing. Correction is down 10 to 20%. Normal, healthy pullback is when you have correction. So whenever you hear correction, that's when it's just consolidating back down to its average. A drawdown is a peak to the trough tough loss. Peak to the tough loss is how much you'd lose. Recovery is the time back to the old highs, months to years sometimes. And then DCA is the dollar cost averaging, investing the same amount each and every single month. So when the market goes up, it is like climbing the stairs steadily. When the market goes down, it is like falling in an elevator, right? A slow climb, a fast drop. So in a bull market, there is a slow climb over months, if not years. Example would be from 2009, again, from 2020, there was an 11-year bull run. Then we had a scary drop, about that 20% drop. And that happened in 2020, March 2020. Why? COVID, right? 30% drop just in 1 month. Good news. The market always recovers, but that keyword is eventually. All right. So technical definitions is long-term SPY average is about 10% on average, but that includes a 30% years and 20% bear markets, right? So that's one thing to be able to keep in mind. Memory trick, you stare up and then you elevator down. A visual look at what happened. The crash of SPY, right? 34% drawdown in 5 months, right? So then you have a real bear market that activated and it lasted for about 21 months. It took 21 months to recover, right? But fully recovered and both have new highs. So understanding the market cycles is that when we're in a bull market, the average length is for about 4 to 6 years, slow, steady climbs with small dips. Most time we are spent in a bull market, but there can also be a correction from 10 to 20%. These are healthy and normal, happens about every 1 to 2 years, usually recovers 3 to 6 months. Good buying opportunities. You buy the dip, right? You buy in correction sometimes. And then a bear market is down 20%, average length for about 9 to 18 months. This is a fast, scary drop, happens every 5 to 10 years on average, right? Recovery takes 1 to 3 years typically. Long-term returns, why? So if we invest $10,000 in SPY from 93 to 2025, it would have from 10,000 to about 180,000. That's 10% annual return, despite the crashes in 2020. So tech crash or stock market, that was the tech bubble or the Y2K. Then we had the recession, COVID, and then bear market. Patience wins, stay invested through the dips. Dollar cost averaging or DCA is going to be how you're going to buy and buy through the dips, right? This is the time in the market beats time in market beats timing the market. But how? DCA invests the same amount on schedule. Example, $500 into SPY every month, no matter what. So think of it like a subscription to the stock market. Netflix is $15 a month for shows. For DCA is $500 a month for wealth building. Why DCA works? Here's the math. If you invest $500 into SPY, and again, not financial advice, this is merely educational. If you do seek financial advice, please make sure you talk to a certified financial planner. Those are the licensed in order to assist you. More shares, right? You're adding more and more shares, right? Even more shares here. So total invested was 3,000, but the shares you have is 5.21. The average cost per shares is $7.93. Average price is $5.83. The average cost is lower than your average price. You bought more shares when cheap and fewer when expensive. So DCA versus lump sum versus timing. Lump sum wins 68% of the time the market goes up. DCA wins 32% of the time, protects against bad timing. Why? Most people don't have a lump sum of money. They earn monthly. DCA removes the paralysis of should I buy now? Sleep well, squeeze out the 1 more percent. The best strategies automate X amount into SPY and then forget it. And then you set it and forget it type of strategies, right? And doesn't make sense. One of the most liquid assets out there, right? What is the difference between a correction and a bear market? A correction equals 10 to 20%. A bear market equals negative 20%. I think I've heard that before. They're the same thing? Not. A correction is worse than a bear market? Probably not. So just by process of elimination, we're able to deduce that was A. Why? Correction equals 10 to 20%. Happens every 1 to 2 years. This is normal market activity, normal buying opportunity. A bear market is negative 20%, happens approximately every 5 to 10 years. This is a little bit more serious. During a COVID crash, the SPY dropped 34% in 1 month. What happened next? It took 10 years to recover. It recovered to new highs in just 5 months. Did it? Yeah, 2020 was kind of a weird year. It never recovered to pre-COVID levels. It did recover, right? But it didn't take 10 years to recover. Market recovered fast. By August 2020, 5 months later, SPY hit new all-time highs. Fed stimulus plus reopening hopes drove the rapid recovery. Remember, everything was closed, right? And everybody was hoping, okay, if we reopen, we can be able to stimulate the economy, right? So they had their dovish hopes to be able to pump more money back into the economy. And then you had the Fed that were stimulating the economy. How are they stimulating the economy? By keeping the rates low, if not cutting at all, to be able to make sure that they want to be able to pump more money into the economy to be able to drive more rapid recovery. So, what's SPY long term average annually? 3 to 5% barely beats inflation. Probably not. Roughly about 10%, including dividends. No, including, yes. You got to be able to put that in there. Roughly 20% market always goes up fast. That's not the case. So, just by process of elimination, we're able to deduce that was B. Beautiful. Let's go to our next lesson, which is going to be the sector rotation and what moves SPY. So sector is going to be a industry group. It's going to be like tech, healthcare, finance, etc. Rotation is going to be money moving between sectors, tech to energy, or energy to finance, finance to healthcare, healthcare to banking. You get it? So just moving from one industry group to the next industry group. Top holdings is going to be the biggest stocks in SPY. This is going to be Nvidia and Apple dominates. You have both of them are, I think, over $1 trillion market cap. Yep. Concentration is going to be how much weight is in the top 10. SPY's concentration in the top 10 is 38%. And then diversification is going to be the spread risk. There's 500 stocks versus one. I think that's quite diversified. So SPY has 503 stocks, but the top 10 control everything. So think of it like the basketball team. Nvidia star players is 7% each. The top 10 equals the starting lineup, 38% of the team. The 493 stocks are the bench players, 62%. When Nvidia goes up 5%, SPY goes up 0.35% just from Nvidia. When small stocks goes up 5%, SPY barely moves, right? Because it is the market cap based weighted. Bigger companies have a bigger impact. Top 10 companies equal roughly about 38% of SPY's total value. The tech sector dominates at 34% of the index. Memory trick, the top 10 equals 38% of SPY, and then of that 38% makes up tech at 34%. So here's a breakdown of it, and we went over this before, of the top 10 companies within SPY. So I just went a little bit before that, right? And the remaining 97 is 62.52, and that's kind of crazy. So what this means for you, when you buy SPY, you are mostly buying Nvidia AI chips, Apple iPhones and Macs, Microsoft Windows Azure Cloud, Amazon, which is Amazon stores, and then AWS. You're buying Alphabet and Google, so YouTube, Google, so search ads and clouds. If tech crashes, SPY crashes. If tech rallies, SPY rallies. You're not diversified away from tech with SPY. So sector rotation explained. Money flows between sectors based on the economic cycles. When we're in a bull/recovery market, tech consumer stocks lead the way, are growth stocks. When we're a late cycle or inflation, we're going to be putting our money in energy, financials, and then material output performs. When we're in recession or a bear market, we're going to be putting our money in healthcare, utilities, consumer, staples, defensive. SPY holds all these sectors, and you go get the average. So you get the averages. All right, so let's go ahead and jump into our quiz. How much of SPY is controlled by the top 10 companies? 10%? You weren't listening. Roughly about 38%. That sounds about right. About 75%. That'll be extremely concentrated. If Nvidia 7% of SPY goes up 10% in one day, SPY will go up approximately 10%, the same of SPY. Not really. It's going to go up by the weight, right? So the 7% weight times the 10% moves is 0.7%. So that sounds about right. And it's not C, the 1%. You don't round up. I wish. Yeah, it's exact. Which sector dominates SPY, right? Financials, banks are the biggest. You would think, but no. Healthcare, aging population, you would think, but no. Technology with 34% of the index. Technology, 34%. excuse me, 34% of SPY, Nvidia, Apple, Microsoft, and Google dominates. SPY is basically a tech-heavy fund disguised as diversified. All right, so our next lesson is going to be SPY options and hedging income. So a call is the right to buy a option at the strike price. This is going to be a bullish bet. A put is the right to sell an option at the strike price. This is going to be a protection or bearish bet, right? Bullish bet, we think the market is going to go up. A bearish bet is we think the market is going to go up, so we want to buy some insurance, so that's why we buy puts. A strike price is going to be the price where the options are activated. Key decisions are made. Do we want to buy the option, right? Do we want to sell that insurance, right? If it reaches the strike price. The premium is going to be the cost of the option, what you paid for up front. Zero DTE is going to be 0 days to expiration. This is where I live, right? This is normally the type of options that we're trading. These are same day options, but super risky, right? But super beneficial, that risk reward. You got to risk it to get the biscuit, as they say. So options equal insurance, or you're betting on SPY, right? So an option, layman terms, equals insurance, or betting on SPY. When we buy a put, this is an insurance policy. So an example would be SPY is currently at 660. We buy a 590 put for $5, right? Or 500. If SPY crashes to 550, your put is now worth 40, right? You protected your portfolio, right? And you also have a decision to make. Am I going to sell or am I going to buy, right? A sell, right, is collecting income. You own 100 shares of SPY and you sell at 610 and then call for $3. Now we collect premium of 300 immediately. If SPY stays below the 610, we keep the shares plus the premium. Warning, zero DTE options are gambling, right? I mean, depending on how you do it. If you're using an algo bot, I probably can argue with that. But if you're doing it yourself, yeah, fam, man, that's not nothing short away from gambling, right? So a technical definition, you may see this again, so I'll probably remember this, is SPY options are the most liquid option market. 200 plus billion in notation value traded daily, right? So SPY options equal the most liquid in the world. So here's a live example of it. So SPY price is 693. So the market is closed right now. So this price is maybe a bit inflated because looking at the next day or not the current day. These are already expired. So just be able to keep that in mind because where I'm recording this. So put is going to be the volume of today. And then I'm recording this on February 9th, 2026, whenever you're watching this. So volume is going to be $2.6 million. Open interest is going to be 246,000 people that have puts or protections. For volumes for calls, right, 2.7 or 231,000 people that haven't currently opened. The put call ratio is 0.97. This is a balanced market. Zero DTEs are extremely risky. They expire today. So there are 3 different types of strategy that we can do, which is a protected put. This is when you own shares of SPY. You buy puts for insurance. The cost equals the premium, like insurance. The benefits, it limits your downside. A covered call is when you want to generate income, or it's called a will strategy as well, but let's keep going. You own shares of SPY and then you sell the calls against them. The income is going to be the premium collected immediately, and the risk is capped by the upside if SPY rallies hard. And then we also have a cash secured put, right? We're going to acquire SPY cheap. We're going to sell puts and then collect a premium and then buy if assigned. The income, premium while waiting. Risk, we're going to buy if SPY drops. This is how most hedge funds get into it. Get into like their option trading as cash secured. Because you collect premium while you're waiting, right? Then you have a decision, all right, do I want to get in? If you normally do want to get in, so why not make a little bit of money while getting in? But again, that's super, super, super expensive and risky to be able to do. And here's a few mistakes that normally are happen, right? Trading zero DTE for quick money. 95% of zero DTE traders lose. I won't say it's pure gambling, but it's a form of gambling if you're doing it yourself and not with a bot. Selling naked calls and options are the ultimate risk. One bad day equals your account is going to be blown up. ignoring IV, which is the implied volatility, but it's depending on how you manage that, right? There's different ways to be able to manage these different types of risks, but again, these are some of the most common ones that we've seen. High IV equals expensive options. You're overpaying and not understanding time decay or what theta is doing to your ass, right? Options lose value every day as expires to expiration, right? And with zero DTE, lose value every second. So that's why you have to be able to know how to properly get in and get out. So you own 100 shares of SPY, right? And you want crash protection. What do you buy? We buy a call option, right to buy. We want the protection, right? So that's not really the protection. The protection is going to be a put, which is the right to sell more shares for diverse. That's funny. So just by process of elimination, we're able to deduce that it was a put, which is a protection. Puts are for protection. It gives you the right to sell at a set price. If SPY crashes, your puts gain value and then offsets your losses. What is zero DTE? Options expiring in 0 days or today. Options with zero fees, I wish. Options on the S&P 500 index. So just by process of elimination, we're able to deduce that it is A. Covered call strategy means we're going to buy calls with the hope that SPY goes up. We own the SPY shares, then we're going to sell calls against them for income. Or we're going to buy put protection, puts for protection. So a covered call, right? So you own the shares and then you're going to sell against them for income. Beautiful. Covered call equals you own the shares and then we sell one call. We're going to collect a premium, but we're going to cap our upside if SPY rallies to the strike. And here's our last lesson to be able to wrap this up. SPY versus the other ETFs. So QQQ is the NASDAQ 100. This is the tech heavy. This is the top 100 non-financial stocks. So the top 100 tech companies within the NASDAQ. DIA, which is the Dow 30, the 30 blue chip companies, price weighted. And then we have IWM. IWM follows the Russell 2000. The Russell 2000 is the top 2,000 small cap companies, high volatility. And then we have volatility is how much the price strings higher equals more risky. And then we have beta, sensitivity to the market greater than 1 equals more volatile than SPY. So SPY is the all-star team, best 500 large companies, balanced and steady. QQQ is the tech dream team, 100 biggest tech stocks, high growth, but is very volatile. DIA is a veteran team. DIA trades the 30 blue chip companies, stable and low risk. And then IWM is the rookie team. This is the 2000 top 2000 small cap companies, high risk and reward. Each ETF targets different segments of the U.S. stock market. SPY is the large cap balance. QQQ is the tech growth. DIA is the blue chips, the top 30 companies, right? So there may be some overlap. Nvidia is definitely going to be in there. Tesla is definitely going to be in there, right? Microsoft, Amazon is definitely going to be a blue chip company in there. IWM, not so much. IWM are small cap companies. These are companies under 300 million to be able to be an IWM or small cap company. Different ETFs equals different market segments, right? So SPY, 503 holdings, large cap focus. Beta is going to be 0.1. Most investors, this is best for most investors, core holding. QQQ is going to be tech friendly, right? Beta is going to be 1.2, so a little bit more risky, right? Growth seekers, right? DIA is going to be for blue chips. This is the Dow 30, so it's a little bit less risky than SPY. And then we have IWM, a lot more risky than SPY. This is for risk takers. So this is the 4-year average. As you can see, QQQ is leading the way a bit. Why? Because it is tech friendly. If you figured out what happened in tech, right? You got Nvidia that had a little bit of the pop. So this is all benefiting off of the AI boom these past 4 years, right? SPY is a little bit more diversified. Yes, it is still being benefited from that, but QQQ is going to be a lot more beneficial from that. DIA, yes, it still did pop, but it's not going to move as much. And then we have IWM, not as much because, again, small cap companies are going to pop, but not as much. 2022 was a bear market. All was down. Then 2023, 2025, the tech rally QQQ outperformed. So which ETF you should choose is all based off of your preference, right? So I'll let you go ahead and take a snapshot of that. Let's keep going. So most common portfolio allocations is going to be 70%. Yeah, so I'll just stay there, right? So just a cool example of that. So which ETF has the highest beta? Beta is going to be risk, right? Most volatile. Is it going to be SPY? Not really. This is going to be large and large cap balance, so not really the highest beta. Is it DIA? DIA is blue chip veterans. These are the top 30 companies, so not really that much. Or is it going to be IWM, small cap companies? So just by process of elimination, we're able to deduce that it's going to be IWM. You have 100K, you want a balanced portfolio. What is the best allocation? 100% in tech. That's probably not it. This looks like a little bit more balanced consolidation, right? Being able to put it a little bit more everywhere, right? 25% in each QQQ, DIA. But you're probably not going to win with this last one, right? So just by process of elimination, we're able to deduce that it's B. Beautiful. You could only own one ETF forever. Which one would be the safest choice? And that, just based off this conversation, is definitely going to be B. All right, beautiful. So I really do appreciate y'all being able to learn what we did talk about today, and which was the S&P 500. This is the largest top 500 companies within the U.S., within America, right? SPY is the ETF that tracks the S&P 500. You have an expense ratio of 0.9, and this is one of the most liquid. Liquidity means you're able to get in and out of the ETF a lot easy, right? The top 10 holdings represent 38% of SPY. This is concentrated in tech, and tech has 34% of that, right? And long-term average is about 10% annually, despite the crashes. And use SPY as your core holdings and consider QQQ DIA for satellites. So if you haven't already, it is your boy Creative. I need you to go ahead and like and subscribe the video. We'll be back at it again with another episode.